Good morning, or depending upon where you're at, it could be good afternoon. I'm Tom Alston, and the handsome young man that you see up there is Forrest Owens. He's going to do a presentation called Aircraft Managers, Your Frenemy. But first, I'm going to play a little short video. Welcome to another Aero Marine free webinar. Let me tell you who we are. We help people who are buying aircraft, vessels, and vehicles to legally avoid the California tax. Just because you're a non-resident of California doesn't mean you're not subject to their assessment. So be smart about all of that. We do these for you because we're trying to give you free information. We do this all the time because you need it, because you've asked for it. And if you've got any subjects that you'd like us to cover that you haven't heard us cover in the past, just send me an email or call us at 916-691-9192 and we'll get you the information that you asked for. And Forrest, you're on.
All right, very good. Thank you, Tom, and thank you everyone for joining. We've got an interesting topic today to talk about, but before we dive into the material, I'd like to tell you about myself just a little bit.
Let me stop you for a second. I forgot one very important part. Anybody who's on watching this, you can send in questions at any time. Don't hold questions to the end. Text them in and we'll make sure they get to Forrest and we'll make sure that you get your questions answered. I apologize for interrupting you. I didn't do my job correctly. So back to you.
Okay, and to follow on to that, please do send your questions. It will make my job presenting this information easier and also more engaging. So your questions are welcome. Please send them at any time. And I look forward to your questions. So back to what I was saying is that just a little bit about myself. My name is Forrest Owens. I practice exclusively in the area of aviation law, and I've been doing that since 2006. I got into this because I hold an A&P ticket and a private pilot's license, and for the better part of the past decade, my practice has been exclusively dedicated to aircraft and aviation-related legal matters. I get involved in a lot of aircraft purchase arrangements and management structures, and that's one of the reasons for the presentation and topic today. Last year, in 2019, we were involved in 22 turbine aircraft transactions comprising approximately $105 million in transaction activity. So we see this fairly frequently, and I get involved in these issues pretty often. So I was recently exposed to some information that said that anything we're saying can be said in 3 minutes or less, and we'll talk a little longer than that today. But one thing that I wanted to share with you, in my experience, is that when it comes to aircraft and aircraft ownership, most problems for aircraft owners arise in one of three areas, and I call them the 3 M's of aircraft ownership. And those are maintenance, management, and just acts of misrepresentation. Almost all the calls to my office associated with civil problems, associated with claims, associated with potential disputes, are all surrounding these 3 areas. They all arise from maintenance, management, and misrepresentation. And those 3 M's are usually interrelated in some way, shape, or form. But what we're going to focus on today primarily is management and aircraft management terms, things to look out for in aircraft management agreements, and certain examples we'll talk about along the way. So We do need to, as a segue, talk about maintenance a bit. It's been my experience that most aircraft purchasers, meaning, and I say that not all, because there's really two types of aircraft purchasers. There's the turbine aircraft purchaser that will acquire their aircraft and then usually place it under management with a management company or charter operation. And then there's the owner-flown set that flies their aircraft. They buy it, fly it, and operate it themselves. And those are two different distinct ownership groups, because aircraft owners that place their aircraft with managers, or buy it and place it with, for example, a Delta Private Jets, a Wheels Up, an Executive Jet Management, a Jet Edge. Those are just some of the companies that I'm familiar with. They place their aircraft with management. They're not in tune with what maintenance costs are associated with aircraft. Now, they will have been presented spreadsheets, and they may have some idea, but the reality of it isn't really appreciated by a first-time buyer. So, as I indicate here, most owners do not initially understand the cost of maintenance and the exposure to bills that they should expect. Often this information is not disclosed intentionally or conveniently omitted. And some of the examples that are associated with undisclosed maintenance are calendar-driven maintenance. Calendar-driven maintenance is maintenance that comes due on a calendar basis, not on a flight time basis. So, for example, if it's due every year, it's due every year. If it's due every 120 months, it's due 120 months, whether the aircraft flies or not. Another example that I've observed is cycle maintenance. This is a good example of cycle maintenance is associated with aircraft landing gears. Many aircraft landing gears have certain cycle limitations after which they have to be replaced. Overhauls. Overhauls, a lot of times there's a note of a time between overhaul, or TBO, and that needs to be tracked as well. Unscheduled maintenance, as it's highlighted, is of particular importance, because that, in my experience, tends to be the one area in which aircraft management companies do not disclose the expected cost or factor it into the budget. Obviously, because it's unscheduled, it's not factored into the spreadsheet, it doesn't make it into financial considerations, and then it causes future heartache for an owner when they experience unscheduled maintenance, especially if they're responsible under the maintenance terms for aircraft maintenance. ADs, or advisory directives. Another point, failure to sync maintenance schedules. Failure to sync maintenance schedules is interesting, and I want to talk about that for a moment, because you can sync an aircraft's maintenance schedules along calendar and hour requirements, so that when the aircraft is down for maintenance, you can do all the maintenance at once. Oftentimes, depending on how an aircraft is operated, there will be a failure to sync maintenance schedules, which may create the need the aircraft will be cleared, returned to service, and then it'll shortly thereafter have to go back to the shop and create additional downtime. And over time, good managers will sync maintenance schedules to avoid downtime and maximize charter revenue. Another thing to talk about is maintenance programs and their transfers. There's a lot of maintenance programs. The common ones are engine coverage, including Honeywell, MSP. You've got Rolls-Royce Corporate Care. You've got JSSI. Managers need to be very careful, and owners need to be aware of those, so that they choose the best maintenance program and that transfers are done correctly. Another thing to briefly mention is plug-and-play maintenance. Plug-and-play maintenance is essentially if you part on, part off, meaning you take a part on, you replace it with a new part or an overhauled part, and then an owner is charged for that. A lot of times there's opportunities to save money, avoid plug-and-play maintenance, but that usually falls on the manager. And then finally, who's responsible for maintenance? Sometimes managers will assume the responsibility for maintenance. Other times it's shifted to the owner. In my experience, I've noticed that when a management company assumes responsibility for the maintenance, meaning the cost for maintenance, the aircraft owner will be much happier. And the reason for that is that they'll avoid unforeseen maintenance expense, which tends to be the most disturbing thing. I call it the open wallet syndrome, meaning we all spend money every day, but if our wallet's open and someone can continually come in and take money out of it without our control and our ability to put it back in our pocket, it makes most people, including aircraft owners, uncomfortable. They can't stop the loss. So if you can shift responsibility to the aircraft manager and they take responsibility for it, great. It seems to make for a much happier aircraft owner and a much longer relationship. The downside to that is that if the aircraft manager is operating on a shoestring or overly conservative with regards to the maintenance they perform, you have to be careful with regards to the return condition of the aircraft when it comes back off of maintenance. So just keep in mind who's responsible for it. It can be a point to consider. Now, let's briefly talk about, as an intro to different management types. We've got Part 91, which is thrown around a lot, which is essentially non-commercial activity. It is the corporate aircraft operation. Most companies that operate their aircraft and have a flight department operate an aircraft Part 91. The other option is Part 135, which is on-demand charter operation. And on-demand charter operation is the NetJets or the charter operator where you call and book a charter and then your flight is flown. There can be strict Part 91 management arrangements, strict Part 135 management arrangements. The most common type that I see is a hybrid, meaning the owner operates the aircraft or assumes operational control under Part 91 under some circumstances, and then under other circumstances, the charter company assumes exclusive operational control. Then there's Part 134.5. That's not a real management type or not an appropriate type, but it's essentially when a non-commercial operator operates in violation of the rules and operates more like a charter company without a license than a legitimate operation under Part 91 or 135. South Florida, just by way of South Florida, seems to be a hotbed for that type of operation, based on my observation, because of flights back and forth to the Bahamas. People like to take friends back and forth to the Bahamas and offset their cost, and by doing so, often enter 134.5 arrangements, either knowingly or unknowingly. And the FAA, interestingly enough, has recently set up, they now have 2 attorneys in the South Florida FSDO office exclusively dedicated to, apparently, dedicated to policing illegal, what I call Part 134.5 arrangements. So it seems to be that it's going to be a particular area of increased enforcement with the FAA. That may be the case in other parts of the country, but it's certainly true in the South Florida area. Another type of management arrangement, or consider a management arrangement, it's really an ownership arrangement, is fractional management or fractional ownership. That's your flex jet and your net jets, and in some cases your wheels up type ownership. Ultimately, those companies assume a management role of the aircraft, and by doing so also assume operation of it. It's really an ownership type, but I also include it as a management type, just to be aware of, is a co-ownership and joint ownership arrangement. Those types of arrangements usually create nuanced management structures for usually an individual manager that manages an aircraft on behalf of multiple owners. And then there's, I call it the twilight zone. There's multiple different types of management arrangements where I've seen these because they come to my attention in basically trying to unscramble the omelet. But you'll have managers that co-own aircraft with owners and then operate the aircraft out of the same entity. Again, not something that's encouraged, but something that comes up, something that you should be aware of. Generally speaking, legitimate management types fall into Part 91, 135, a hybrid of the two, or some type of fractional arrangement. So, types of arrangements, Part 135, charters for owner. All passenger flights are operated by the manager under 135, including flights for the owner. It's been my experience that when a charter company assumes exclusive operational control and operates the aircraft on behalf of the owners, it's usually a handoff or a complete handoff by an owner to the manager of the aircraft and its operation. I have found that this particular exclusive Part 135 is attractive to aircraft owners that are concerned about liability issues. Those liability issues, you can shift liability to the charter company and shift it away from the aircraft owner. The downside of that are tax issues or potential tax issues associated with the allocation of depreciation, where the deductions fall. There's PAL stands for passive activity loss and sales and use tax. The other issue is that on 135 flights, FET applies. Now I've gotten a question that's come in. I'll read that in just a moment. Okay, so the question that I received, which is a good one, it says, do aircraft owners typically consult with an attorney or have legal representation before entering into an agreement with a management company, or do they negotiate the contracts themselves? I would say it's half and half. A lot of times, a lot of times, in my observation, the worst arrangements come from the directly negotiated contracts. And that is because it's usually a manager that is trying to create an advantage for themselves. So it's not negotiated through an attorney, and it's not usually involved with, and counsel's not involved. Frankly speaking, the longer I do this, the more that I realize that my role is almost that of a grader or someone to double check the work of others often, and sometimes be in the room just to offer a note of caution. So if there's no note of caution, sometimes bad results can happen. Sometimes undesirable results happen even if you do hammer out an agreement with the best of intentions. But people often don't seek counsel when they're structuring the business arrangement of their aircraft management. Or if they do so, they do it after the fact. All right, so as we continue, and thank you for your questions, please, I thank you for the one, please send more. Let's talk about Part 135, or Part 191 arrangements. And in this case, just so you're aware, managers may not have a Part 135 certificate, meaning they're not a charter operator. And the aircraft will only be used by the owner or another Part 91 operator. The nature and degree of support services from managers vary. I've seen this vary across the board, from a very active level of management almost to bookkeeping only. So when it's a Part 91 arrangement only, I will say that the terms involved in negotiating these agreements becomes more involved because there's more detail and more differences when you're dealing with Part 91 management arrangements only. That said, managers do usually provide services requiring aviation expertise, and that would usually include maintenance oversight, as well as hangar and other things. Sometimes, Part 91 managers will also select the crew often with the acceptance of the owner and arrange for perform maintenance, perform record keeping, and just facilitate the operation overall. This goes back to what we talked about at the beginning, but the most often type of management arrangement is Part 91 and 135. And common arrangements, these arrangements are usually used by owners to offset part of the cost of owning the aircraft. I say that because that if there's any representation by a manager that the operation of the aircraft will fully cover the cost of owning the aircraft and/or debt service, it's a huge red flag. Most of the time, the arrangements under 135 will only offset the cost of owning the aircraft. Then there's so owner flights are usually operated on Part 91. Third-party charters operated 135. Usually, the owner will typically pay for all the costs associated with maintenance incurred for operating 91 or 135 flights. And the owner and manager typically have some type of revenue sharing arrangement that we'll talk about in a bit. Going back to Part 135 flights for the owner, we mentioned this before. Let's see if I can go through the slide, but most folks operate 135 exclusively for liability issues and do experience some issues associated with taxes, specifically from passive activity rules. And let me see if I can. Okay. We're going to go through this slide on to the next, because we've talked about the overall structure. We're going to talk about contracting issues, just generally overall as you set up these management agreements. There's two types of contractual issues. There's the business issues that affect regulatory certification and operation, and then there's just general business contractual issues that have to be hammered out. In my experience, especially with 91 management, it's client by client determination. Every single situation tends to be unique. And a lot of those things are driven by how much time does each party want to commit. In the case of jet owners, it's my experience that they really want to commit a lot less time than they think. They really want to take a hands-off approach if they can, and often do. But initially, depends on the arrangement, especially with smaller charter operations, they tend to get much more involved in the in the business aspect of the charter operation, usually because they're an investor, or they've been approached by the charter operation to invest in the company, usually by buying an aircraft and placing it on charter. If, going back to 135, if the aircraft is operated 135 exclusively, there are issues associated with Part 90 limitations on runway length and duty time, so you have to explore the particular operations of the client, whether 91-135 works for them. With regards, these are issues that need to be talked about with management, which are crew employment, who's going to employ the crew. Sometimes workers' compensation issues are involved. Eligibility for benefits. A lot of times, aircraft owners will want to place their, sometimes they will want the pilots to be paid by themselves and with the assistance of outside management, or if it's a charter company, a lot of times those pilots will be employed directly. Insurance issues. If it's a 135 operation, most of the time the 135, the 135 company will have a fleet policy that they will have in place to insure the aircraft. If it's a Part 91 operator exclusively, it'll be a standalone policy. If it's a hybrid, it will usually fall to the fleet policy of the charter company. And then it's always important to address with insurance who will be the named insured and who will be the additional insured. For the most part, the named insured is usually the aircraft owner, and additional insured could be a number of operators that operate the aircraft. Again, it's a case-by-case determination, and these terms have to be hammered out in the agreement. Keep in mind the structure of the business and the relationship and the allocation of responsibility between the parties can affect the classification operation for the FAA, IRS, and state purposes. Part 91 provides operational flexibility, but then it becomes an owner responsibility. Part 135 has the applicability of federal excise tax, and then there's always the question of who is in possession, command, and control of the aircraft. And for tax purposes, this frequently comes up. Will the aircraft operation be classified as passive activity for the owner, such as leasing? Many aircraft owners will seek to classify their activity as active, meaning they're actively involved in the trade or business of operating an aircraft or leasing it. And it can be a challenging planning hurdle to overcome if the owner doesn't have what's called passive activity. Passive activity is usually per se, leasing is per se passive, or investment income would be considered passive. Your ideal aircraft owner would have significant passive income to offset passive loss. And then how will we deal with state sales or use tax, and how will they apply? Most of the time, I try to shift the responsibility of that tax to the management company, if possible, especially if it's a Part 135 company. On the contracting issues with an aircraft that goes under conformity, a question comes up. There's always a conformity cost. So it needs to be raised and determined who's paying for the conformity inspection. I generally try to shift the cost of conformity to the manager if possible. Sometimes that's not the case, but usually the manager is in the best position to control that cost. When you have an owner that's placing an aircraft with a management company, the aircraft is going to have to go on the op specs of the company. or operational specifications for charter purposes. And this can take a different amount of time depending on the authority of the operator. Some operators are self-conforming, meaning they have other aircraft of that type, and they can easily conform another aircraft. However, if this is the first aircraft of type, like a G5, it's the first G5 that they've ever had on certificate, they'll have to do proving runs for the local FSDO, which will incur expenses associated with actually doing those flights. So that has to be examined. Be realistic about the timing. A lot of aircraft owners, when they acquire an aircraft, hope to generate or offset cost immediately. And depending on how long conformity takes, it can take 30 days is usually quite aggressive. Sometimes it can take 90 to 120 days, depending on the FSDO you're working with. So that needs to be explored even prior to entering the management/charter arrangement to determine expected time frame. On to the crew. As far as an issue to address in a management contract or crew issues, sometimes an aircraft owner will bring their crew with them, and then they will be hired by a charter company. If that's the case, terms need to be addressed with regards to what happens when the crew is dismissed. Are they allowed to go back and work for the aircraft owner again or not? So that needs to be considered. And again, maintenance issues need to be addressed. Who's responsible for maintenance and how that's addressed. And one thing that is a common term that I like to put in agreements is some threshold for maintenance decisions, so that if a management company has a maintenance event that they have to go to the owner, for example, if the cost is above $10,000, that seems to give a little bit more control and more comfort to an owner. Now, I'm going to see if I believe I have a question here. There's a question about insurance, and we'll get to that as we get to insurance. I'll talk about that specifically. So thank you for your questions. So more on maintenance. Specify the maintenance program if they exist. Identify a financial threshold, which we talked about at $10,000. Address who's going to pay for the crew, their passive time. Address is there handling charge for parts from third parties? Most of the time it should be considered that there's no markup. And then how do you monitor the aircraft maintenance? A lot of times I have owners that will hire an independent maintenance consultant to monitor what's called camp. So they'll log into camp and make sure that everything is being done correctly, or at least keep tabs on it on a monthly or quarterly basis. There are also common aircraft use restrictions that need to be addressed in management agreements, including geographic limits, limits on permissible charter, prohibitions on carrying pets. I was on a run for a while where everyone, I don't know why, but it seemed like everyone wanted to exclude, well, I know why. Everyone, it was a common term to exclude red wine, and that was due to damage to the interior. Now that's also been expanded to, and smoking is kind of a given, but many management contracts now include limitations of use associated with vaping. One thing that needs to be paid special attention to is lender or leaser restrictions. associated with the operation of the aircraft. It's not uncommon for loan documents to have specific restrictions in them that need to be taken into consideration with aircraft management. If both agreements are not looked at in conjunction, you can miss some important terms and potentially breach covenants with the aircraft lender. Many times when aircraft goes under management, they'll typically take a deposit that's equal to 1 or 2 months worth of the operating expenses. This is justified for the manager just to cover their cost. It's not uncommon for aircraft owners to not pay bills immediately, and setting up an account provides a smoother assurances of financing. But keep that in mind as well. Also need to clearly distinguish who's responsible for flights, and this is associated with the operation of the aircraft. Clearly distinguish between 91 or Part 135, and this is due to operational control issues. Remember that the owner who has operational control of Part 91 flights, which usually is an individual. Don't say that the manager is operating the Part 91 flight, because it's actually the customer who is. Don't say that the owner is, meaning the aircraft entity that owns the aircraft. Don't say that they're the operator. And then just address who has operational control of positioning and maintenance flights. That's usually the aircraft manager. And what is the manager's obligation to advise the owner of flight department company issues? To mention, the flight department company issue is one where an entity operates an aircraft, and that operation is not incidental to its real business. So we could talk at length about that, but conceptually, if it's a single purpose entity that doesn't have any further business other than owning an aircraft, then it doesn't have business that's incidental to operate an aircraft. By way of an example, I like to use a soda company as an example. A soda company's primary business is to make soda or pop, depending on what part of the country you're from, and bottle it and then sell it, or make the syrup to make soda. That's their business. But many of those companies also operate corporate aircraft, but that operation of that corporate aircraft is incidental to their primary business, which is making soda. If you don't have operation incidental to the primary business, then you have a potential flight department company trap issue. Those need to be walked through between the manager, owner, and customer as well. We also need to talk briefly about the issue of taxes. And this comes up with some sensitivity in exclusive charter arrangements, and the responsibility of it also arises, who is collecting that tax? Is it the manager / charter company, or is it the owner? Managers generally assume responsibility for the collection of federal excise tax, and owners often assume responsibility for the collection of sales or use tax, or contractually that obligation may be shifted under some circumstances to the manager. I just received another question. It says, question about filing federal state taxes. If a plane partnership is under a corporation but no income for plane rental, is filing taxes still required? We have a partnership corporation owning the plane but not receiving any income and have not filed taxes for 3 or 4 years. What are the requirements? What are your recommendations? Thank you. Now, let me qualify this as that I'm an attorney and not an accountant, but it is my understanding that if it is necessary for an entity that's in business to file tax returns, whether it has business or not, or whether it recognizes income or not. So it's important to file your tax returns regardless. On that particular question, I would ask your primary tax advisor and who's filing your taxes what their suggestion is. I suspect it would be consistent with filing your tax returns, even if you don't have income. There we go. So again, thank you again for that question. I appreciate that. Be clear about each party's tax responsibilities, and we talked about that. And then if it's an owner responsibility, we need to make sure that it happens timely. Often, if it's a sales tax issue in the state of Florida, my office will often monitor those filings and ensure that they're done timely. With regards to, again, terms of the contract, charter cost and revenue, who receives the money and how it's received is important. Most of the time, in my experience, the proposals that I see are 88-12 or an 85-15 split, meaning 88% of the revenue goes to the owner and 12% goes to the management company, or 85-15 on occasion. And then you'll note the question mark there. That's noted because sometimes I've often seen recently where an aircraft manager will lease the aircraft from the owner at a set monthly rate, and there won't be a share of charter revenue. And that seems to be a very favorable arrangement for some owners, and they really like it because they know what they're going to receive every month. For example, they'll receive $30,000 every month for a term of 3 years. So they know contractually the amount that they're supposed to receive, and they're not necessarily concerned about monitoring the actual revenue of the charter activity. So that can be an arrangement as well. Another point that should be that we'll talk about, and that I always like to push for owners in particular, is some type of guarantee of charter activity when it goes under 135. And for example, there will be a guarantee of 400 hours per year of charter activity. And if you can get some type of guarantee, or at least raise the issue, it tends to create a very productive dialogue. And I say that because if there's no guarantee of charter activity, then it raises a question. If they'll guarantee 600 to 800 hours of charter, that also raises questions because it's quite, from a logistics standpoint, it can be quite difficult to get that much charter activity. So it's a real good barometer to see where a charter company is at if you can ask them for a charter guarantee. But again, that guarantee is only as good as the paper it's written on. Another thing to mention, to go back to the earlier question associated with insurance and indemnification, the rule of thumb for management companies that I see is that insurance is the sole recourse in the event of loss, meaning whatever the proceeds of the insurance are, that's what the parties are entitled to in the event of an accident. And there's not an opportunity to go beyond policy limits, at least in the contract. Now, from a practical standpoint, because frankly in aviation, almost any activity, or if anything occurs, it arises to a level of gross negligence. There may be the ability to set aside that term, but as a contractual term, at least for the parties, the goal is to address insurance only, or have all claims addressed by insurance. only. And as we wait for the slide to load, those are just some of the things to look for as you're negotiating or in consideration of management companies or management contracts. Look for those terms. There's a lot more to go into even than those things. Management contracts can be quite nuanced, and they're each specific. The larger companies, as I mentioned, if they when I say larger, if they have a fleet of 20 to 25 aircraft or more, many of those companies have standard terms. We're rounding out the presentation presently. Tom, can you help me out and help me scroll through the last few slides?
I will.
So that we can finish up.
Where we were back on 26. You were there. Do you want me to go to the next one?
Yeah, if we can go to 27.
Okay.
So I want to talk about briefly the three, going back to the 3 M's. We talked about maintenance a little bit. We spent a lot of time on management and management contracts. Another thing that I want to talk about is misrepresentation. And again, I get calls frequently about misrepresentation by management companies. Many of that comes from things like undisclosed maintenance, undisclosed fees, concealed charges, back-to-back transactions in which the manager is involved in some way in the acquisition of the aircraft, spreadsheets. Spreadsheets are a great tool, and also should also be looked at with a jaundiced eye, because the information in a spreadsheet as presented to an aircraft owner often is most favorable to the charter company. It may not necessarily be or contain information most favorable to the owner. However, because a lot of aircraft owners are what I call numbers people, meaning they fixate on the numbers, those spreadsheets can become very persuasive depending on how they're put together. And a lot of the spreadsheets that are presented to aircraft owners will present a situation that seems to make financial sense. Factoring in undisclosed maintenance, it doesn't. I want to share with you three examples from firsthand observation of what I would call bad acts or misrepresentation that I've observed, just to give you an idea of what's out there. The first one was an aircraft manager. It was actually specifically the aircraft manager that he was charged with hacking and embezzlement. Now, the embezzlement aspect of it took a while to prove. He ultimately went to prison for it. But the hacking aspect of it is unique. This particular aircraft, this aircraft manager / employee went into the flight tracking software of Company A, downloaded it, then erased it, and then went to Company B with that information. So effectively, he was found guilty of hacking because he went into their computer system and corrupted their flight tracking software. The next example of Wi-Fi is one of my favorite stories associated with misrepresentation. So I had a client that acquired a Lear aircraft, and the manager of that aircraft was also the pilot. That will become somewhat important later. The manager of the pilot would present pro forma invoices to the owner for aircraft upgrades. So in this case, the aircraft manager presented the owner with a pro forma, meaning a quote for the installation of Wi-Fi on this Lear aircraft. The owner gave the aircraft manager $100,000 to install Wi-Fi. Fast forward a couple weeks, the owner is aboard his aircraft with substitute crew, who was the crew for the previous owner. The owner's in the back seat casually chatting with the crew and says, "Oh, it's going to be great when I finally have Wi-Fi installed on this aircraft. And we're supposed to get that done soon." The crew that day, substitute crew, but familiar with the aircraft, said, "What do you mean? This aircraft has Wi-Fi." They pull back the curtain a little bit, show them the box. The aircraft had Wi-Fi installed for a couple years. It was already on the aircraft, but the aircraft manager and pilot had duped the owner into giving him money to install Wi-Fi that was already on the plane. Pretty slick. The third example that I've seen, just to share, in misrepresentations out there, is associated with escrow. And I would say that if you're involved in an aircraft transaction, beware of the escrow company that you use. Vet them. If you are not familiar with the escrow company, or if you're asked to use a company that's not regularly engaged in aircraft transactions in Oklahoma City, beware. I came across the particular company I hadn't seen before, advised the client to avoid it. They decided to proceed anyway. They gave the money to the escrow company. The escrow company represented that they had a deposit for the purchase of an aircraft. The deal didn't consummate for various reasons. We asked, for our money, which was due us, due the seller under the contract. Subsequently determined that the escrow company was defunct. I was thankful on that day that I had made previous written advice not to use that escrow company, because we ended up having to sue the escrow company for the deposit in order to get the money back. Found out that the company was essentially defunct. So those are just three examples of misrepresentation. The biggest misrepresentation that I see with management companies in particular is undisclosed maintenance, unscheduled maintenance. There's a expectation created of a certain maintenance cost that doesn't happen. Sometimes that can be smoothed by programs, sometimes not. Tom, can you go to slide number 28?
Done.
Thank you, sir. So on slide number 28, I'll briefly talk about this case just as an example, because I know we're running short on time now. But this is one of my favorite examples of my favorite aircraft mismanagement examples. As someone who grew up in the Midwest in the 90s, Scottie Pippen, the Chicago Bulls were quite familiar to me, and I saw them every summer on TV in the NBA Finals. So this particular case involves Scottie Pippen, Air Pip versus Peterson and Hope. Now, Peterson and Hope is actually the Chicago firm that represented Scottie Pippen in drafting documents associated with his aircraft acquisition. So maybe the advice in that regard is to hire aviation specific or aviation familiar counsel. I can't say that they were or not. Ultimately they weren't found liable in these cases. So, however, it provides a really good fact pattern associated with what happens with aircraft owners in aircraft management arrangements. So in this particular case, to summarize, Scottie Pippen was approached by a gentleman by the name of Frost. Frost convinced Scottie Pippen to go into partnership with him on the purchase of a Gulfstream 3 They were then going to own interest in the aircraft, 51.49, and then Frost was going to operate the aircraft and basically cover all the costs of ownership and make money. And it didn't work out. When you go through the facts, you see that the aircraft, the cost of the aircraft was inflated. The cost of the ability to make money and charter the aircraft was also inflated, and it didn't work out for Scottie Pippen, and he wound up in litigation for a number of years. My theory on why he went after his attorneys is because they had malpractice insurance, and Scott Frost probably was likely judgment-proof under the circumstances. So ultimately, because they were involved and they didn't tell him not to buy the jet and not to enter into those arrangements, they were subject. That was the reason for the cause of action. So if you want to read through the facts, feel free to do so. This case, again, provides all the warning signs of potential mismanagement, or at least a lot of them that come up frequently over and over again. So if you can, Tom, if you can go to slide 29, please.
Got it.
Thank you, sir. So along the lines of misrepresentation and management, beware of the snakes, and what are the rattles? What are the warning signs associated with that? Keeping it simple, there's 4 things that I often see. Look out for multiple avenues where the aircraft manager can self-deal. Aircraft managers often have the opportunity to sell fuel, oversee maintenance, oversee trips, oversee charter. The more opportunities, the more avenues for self-dealing an aircraft manager has, the more likely an aircraft owner is going to be taken advantage of. The second thing to look out for, at least to be aware of, is for whatever reason, the worst circumstances of mismanagement and misrepresentation usually come when the pilot themselves is the aircraft manager. I'm not saying that's always the case, but it's just a warning sign. And I pay much closer attention to circumstances where the pilot or a pilot flying the plane also manages the aircraft. For whatever reason, that creates some level of temptation for pilots that they don't seem to be able to handle it. The third thing is, going back to what we talked about before, any representation of profit or complete coverage of cost of ownership. Any indication that you'll fly for free is a huge red flag under any management arrangement. Any representation of flying for free, beware. The fourth thing is spreadsheets are perfect world projections. Never forget unscheduled maintenance. So we've talked about a number of things today, and if I could leave you with just the 3 things to remember, just remember when the aircraft is acquired, just remember the 3 M's. Remember maintenance, management, and look out for misrepresentation. You're going to have to navigate those 3 things with your owners. And thank you for your time and attention today. If you can go to slide 30, my contact information is there. If you need to reach me by email or telephone, please feel free. And again, I appreciate your time, attention, and the opportunity to share an hour with you today. Are there any further questions, Tom, that have come in that I didn't see?
Other than a comment about one of the people who's on this thing, that his firm financed the Gulfstream relative to the Scottie Pippen purpose, I don't see anything. So what I'm going to do is I'm going to thank you, Forrest, for your time. I'll apologize for the internet connection problems because somebody has to take responsibility for it, so I'll do it. I thought you did a good presentation. We had a good crowd on here today. Please, if you're an attendee, write all this information down so that you've got a way to contact Forrest. He's given you his phone number. He's given you his cell number. He's given you his address, and do you have a website on there someplace? I don't see it.
The website is on the first. It's www.aviationlegalcounsel.com.
All right, so we've recorded this. It's going to be posted permanently on our website. So anybody who wants to, who's been in attendance, you're going to be sent a link to it. And Forrest, for you, you'll be able to send your clients to we'll give you the link so that you can send your clients so that you can do this presentation for them over and over and over without even having to wake up at that moment. So it doesn't look like there's any more questions, so I want to thank you for your time. Anytime you've got another subject that you feel like is want to put up, just contact us back and we'll make sure to get you on.
All right. Thank you very much for your time and attention today, and thank you for the opportunity to share some information with the folks, Tom. I appreciate it, and it was a fortuitous meeting at NBAA.
Okay. So I'm going to say goodbye at this point, and hope you enjoyed it. And if all of these that you're on, if you have any other subjects or any other celebrities like Forrest that you would love to be on our programs, just contact us and let us know.